Hi there, everyone, and welcome into this week's market update on the 3rd of May. Now, don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Alrighty, so our market closed slightly lower today, but basically held the intraday support here around 7,300. There's heaps of moving averages here, the 50, the 200 there as well in red. So that's all holding at this stage, guys. Okay, so we've got quite a few key moving averages converging at this level. So look, we're at a bit of a pivot point. You can see here in the short term, there's a small uptrend in play coming into a bit of a pennant, and we're just waiting to see which way this is going to break. Overall, we're channeling really at the end of the day, guys. We're holding up fairly well compared to many other markets around the world, and it's just really sideways. That big trend from the bottom of COVID there's ended, and yeah, just whipping around a bit at this stage. Short term trend is up, just confirming whether that's going to continue or not. The big thing is, guys, though, like what I'm probably staring at a bit more is the US markets. They're at some key levels, right? If you have a look here, you've got the trend, same story as on our market. That trend's now broken, right? But the big thing that I'm worried about is they're challenging some key support levels here. They broke into sort of one of the lowest levels that we've seen since what back in 2021, right, mid of 2021. So we're coming back to sort of yearly lows again. But what scares me the most is the potential reversal patterns that we're seeing up here. Flick across to the weekly. There's a bit of a head and shoulders pattern. That's a reversal pattern, guys. What it says to me is if 4150 breaks and we maintain below that level, we could fall down near 3600, right? That's what the technical signal sort of tells us. So this could be a change of trend to down. We're threatening that, or the US is threatening that at this stage, and it's quite clear on the Nasdaq chart. Nasdaq being a bit more heavily weighted towards those growth stocks that get heavily affected by lifting the rise of interest rates. The big question you're going to ask is it all priced in yet? All right, that's the $1,000,000 question. Are all these interest rate hikes priced into the equity market? Will the Fed increase rates as much as what bond markets are telling us, right? They're the big questions that we're asking at the moment. We do not know the answer. Only time is going to tell us that. There is some technical signals here, guys, suggesting that this could turn into a bear market. Warning signs are there. Listen to those warning signs. Watch very closely. Okay, this level here, guys, about 12,500 on this index. If we continue to hold below there after the Fed meeting, so give it Friday, Monday maybe, let the market digest. If we're still below this level and start showing bearish signals again, I'll be changing my view to bearish. Okay, at this point, I don't think it's going to play out, right? But at the end of the day, what I base most of most of my short-term trading decisions on is technicals. Okay, if this technical plays out, then I have to change my view. All right, that's what it comes down to, guys. All right, so there's warning signs. There's huge warning signs here. Don't say nobody warned you. There's huge warning signs here, but we can't listen to them just yet. Okay, they haven't completed. They're just warning signs. So we've got to be a little bit more patient. I think we've got to wait out until Thursday, Friday this week, see whether we're still showing bearish signals under this support level where my mouse cursor is here. Okay, if we're still seeing bearish signals from those levels, then we have to worry. At this point of time, we're in limbo. We're just in limbo. We're going to wait and see. So what's the big problem, guys? It's inflation. Obviously, we've been talking about this for weeks now, months even. Okay. I'm not going to say anything more than I have said before about inflation. Locally, 5.1 was the last reading, a bit higher than expected, and we've seen the RBA lift on the back of that. I'll talk to that in a second. Look, inflation to me is still more supply side, guys. Yes, demand's come up higher because the world's reopening after COVID. There's no doubt about that. But if demand was where it was pre-COVID, we wouldn't be having this problem, right? Not as bad anyway. But we've got outside factors happening. We've got COVID affecting supply chain issues. We've got this war that's happening in Ukraine and Russia that's affecting supply chain problems, and it's in things like fertilizers. It's in insecticides. It's going to send food prices higher. That's probably your biggest worry at the moment is food prices. Okay. Um, Looking at crude, okay, it seems to have topped out for the moment. Russia has found ways of selling oil. People are still buying oil from Russia. Therefore, there's not as much of a supply constraint on oil. Gas, there's problems, obviously in Europe more than anywhere else, and hopefully that gets resolved in the coming year or so. So, look, guys, the big thing I'd be watching out for is food prices. That's I think where the large amount of inflation can continue to happen because most other things. Well, what happens when discretionary goods go up, guys? We hold off buying discretionary goods. It is discretionary. We can go without a discretionary item for a period of time. Okay, staples we can't go without. So food demand won't change that much. Okay, people might ease off a little bit, buy cheaper items, whatever. But food prices, if labor keeps going up, if fertilizers and insecticides and things like that keep going up, well, farmers will have no choice but to hand those price increases on. The other big thing is in meat, right? Feed's going up for animals, so without a doubt, you're going to expect meat prices to go up. So the big inflation that's likely to happen, from what I'm reading at the moment, is around food. Metals have topped out. Commodities outside of food seem to have topped out for the moment. Okay, and if they continue just to hang sideways or pull back a little bit, well, hey, that's where inflation tops out in those areas, or even get a little bit of deflation in those areas. Um, but food, at this point, I can't see the light at the end of the tunnel. I think food prices are going to go up much more than what we've already seen over the last few months. Okay, so that's the big one. All right, so we heard from the RBA today. They lifted rates by a quarter percentage point. And I think the market took it pretty well. The initial reaction was a 40-point fall. From there, the market started recovering slightly up and closed fairly flat for the session, right? A little bit lower. Nothing to worry too much about. Held that key level there at 7,300. So I'm pretty happy with that. Look, the RBA seemed still, they don't use the word transitory, but it is transitory inflation the way they're talking. Okay, they still believe inflation is going to come back down in a couple of years' time. They're blaming more on overseas factors for the inflation. They're not blaming anything locally for the inflation issue, which really means that it's out of our control, right? If you read into that enough, well, there's not much we can do about it, guys, right? Lifting interest rates is not going to fix this problem, right? Lifting interest rates is not going to stop fertilizer being produced somewhere overseas from going up in price, okay? It's a supply and demand problem. So, you can't bring demand down for a staple product like food. It's just, yeah, when it's across the board. What are we going to stop eating? You know what I mean? So look, it's interesting. It's an interesting conversation to be had. But they're saying that it will normalize by 2024. Okay. They're saying unemployment's strong, economy's looking good here in Australia. It's all positive, guys. I read that statement and it sounds positive to me, right? Interest rates going from 0.1% up to 0.35 is a positive thing, guys. It doesn't matter how you spin it. In this environment, we've got a strong economy. Interest rates should go up a little bit. But the key word here is a little bit. Now, the issue, what we're having out there is bond markets are indicating that interest rates might go up to 3%. And that's where the problem comes in, right? If you've got inflation plus interest rates going up to 3%, which means your interest rate on your home loan is going to go above 5, I think that's a problem. Okay, that will decimate the economy, and that's where some fear can creep in. But we're not seeing that type of rhetoric from the RBA at all. Okay, at all. The Federal Reserve, though, another matter, right? They've been talking fairly hawkish, right? A lot of Fed members have been out there spruiking a bit more hawkish recently. And that's what's causing the US market to fall so much. And that's why, ahead of the Fed announcement this Thursday morning, we're seeing the market crack it a bit over there. Okay. I'm not surprised to see those growth stocks selling off heavily to send a message say, hey, well, yeah, if you're going to keep talking this hawkish and you're going to actually act on it, well, hey, why would you want to be in the growth space? Right? You're going to dump that space, aren't you? What's interesting though is the value space has also been falling over the last week. So there's some legitimate fear out there now on the back of the Fed announcement. And I think some of that fear is also coming from China. Okay. And I'll talk to that a bit more in a second. But look, the Fed Reserve is going to be an important meeting Thursday morning. You've got to have your eyes peeled. It's going to happen pre our market open. So it'll be early hours of the morning Thursday. Um, so we're going to wake up and see the futures and know whether the Fed said something stupid or not. They're likely to lift rates by half or even 3/4 of a percentage point. Okay, so that's on the table. I think everybody's okay with that. There was some comments over the weekend though from some Fed members saying that they could look at front loading. What that means is they can sharply raise rates for a few sessions in a row. So they might lift, 3/4, lift another half, and then just sit on their hands for a period of time and see what happens. What the aim of that would be is to send everyone a message to cool their heels a little bit. They just want to cool the economy down a little bit without raising rates to the point where they're just going to decimate everyone, because that's what the bond market's telling us. The bond market is saying that rates are going to go up. They're going to go up quickly, and they're going to go up to about 3% from the central banks. To me, that's crazy stuff. That is crazy stuff, guys, right? Especially for the Australians that have all just gone out there and bought their first home with interest rates down at, variable at 2.7. That variable of 2.7 all of a sudden becomes 4.7 or above 5. Wow, right? You're doubling your loan repayments. That's crazy stuff. Well, not quite, but you get my point, right? It's going to be almost. So look, this is crazy stuff, guys. Like we're talking some interesting things here, and well, I can't see a lot of it playing out. I think a lot of it's just talk at this stage. Um, they're talking hawkish just to cool things down a little bit to get us through this phase of supply chain issues. If we can clear the supply chain problem, then things will normalize, guys. We'll actually end up having a deflationary problem again, like we did before COVID. So look, next year or so is going to be quite interesting, right? Okay, so metals have been falling recently, and that started happening when we heard about further lockdowns happening in China. So Chinese lockdowns are the big thing that a lot of people are talking about in the mainstream media at the moment. Okay, but what people are failing to discuss really is their short-term lockdowns, and they're supposed to be coming out within days or weeks. Okay, so if they're short and sharp, I'm okay with it. I don't think it's going to have that long-term effect that everyone's worried about. But China's also indicated that they're going to start acting to help their economy. Okay, they're going to start boosting the real estate industry a little bit more. They're going to step in. Okay, China's closed at the moment. They'll reopen again on Thursday. So let's just see. But I've got this feeling that things might be okay. All right, but we just don't know what's coming. If China do go into prolonged lockdowns, it's a different thing. Okay, then I'll get scared. I'll be very, very worried about materials. I'd expect commodity prices to crash. Okay, so keep an eye on this space. It's an important space that's going to be playing out over the next few weeks. There's not a problem at the moment. I think China is going to invest locally as much as possible to bring things back up. I don't think they're just going to let their economy fail, right? So they're gonna spend. They're going to start spending big. Okay, is the opinion that I'm hearing. A lot of stimulus, similar sort of stuff is what we've been doing in the last few years. So if China finds themselves in short, sharp lockdowns, are okay. If they find themselves in long, prolonged lockdowns, I think the commodity space in our market's in trouble. Last but not least, look, we're coming through a reporting season as well, right? And that's some of the reason why a few of the stocks have fallen sharply of recent. Apple had a reasonable report, but came out with some worries of forward guidance, and they fell off maybe 3-4% the other night. Amazon was a big one, guys. Amazon was down 14% the other night. That was huge, right? That was a big, big move. So some of the biggest stocks on the Nasdaq and the S&P 500 have fallen dramatically on the back of reporting. Google, Alphabet, that was down quite a bit as well after it reported. So it's not just the Fed, okay? It's also reporting, okay? But I think the Fed, with some negative earnings reporting and some negative forward guidance, the whole interest rates going up thing is just really multiplying it. It's amplifying it, right? So yeah, it's going to be nice to get this Fed announcement out of the way. To be honest, I have this sort of small feeling that we're going to see that whole sell the rumor by the fact. Maybe that could be what's happening here at the moment. So we're going to be at the mercy of the Fed, how they talk, what they're indicating they're going to do moving forward, especially what they're going to do with their balance sheet, right? So, one thing I liked about the RBA announcement today is they told us that they're going to not sell the bonds that they've bought through QE, they're going to let them run to maturity. Whereas the Fed, some of the Fed members have been indicating that they may actually look at sharply selling their balance sheet down, which puts more upward pressure on bond yields. Okay. So yeah, look, it's going to be an interesting one to see how it plays out. Thursday's the day, guys. China reopens. Fed meeting. You got ANZ reporting. Virgin Money Bank is reporting. So look, it's going to be a big day Thursday. All right, lot to digest. I think the market might be fairly whippy and volatile. But Thursday by Friday, we should have a view on things by then. All right, that's all I've really got to talk about, guys. We're at the mercy of Thursday. That's the main thing. Keep an eye on those main support levels on the Nasdaq and S&P 500. That's the major thing I'm watching at the moment. So, thanks for listening in today, guys. Take care and bye for now.